Hi, this is Liqian Ren, Director of Modern Alpha Wisdom Tree ETFs. Welcome to China of Tomorrow podcast series, where we navigate China, India, Japan, and the broader emerging markets with members of Wisdom Tree and other industry leaders.
It's May 14th, 2024. This is Liqian again on China of Tomorrow podcast. Today, I'll quickly cover three things: two domestic China news and one from US. First in China is about the credit data, really low total social financing, M1, M2 monetary data. And the second thing is China did start selling long-dated bonds, 20, 30, 50-year bonds, which was a positive. Previous news was a negative. And then third is this morning, U.S. Officially announced quite some tariffs on Chinese EV vehicles and parts, but actually it's not just those, but also on medical gloves and masks. So and semiconductors. So it's really a little bit broader than the headline, but on the other hand, the immediate impact is small. So I'll go into details of these three, and in general, I think in the last couple months, the sentiment has been quite positive on China, and we've also said that the actual economic data is still quite weak, and that's really reflected in the total credit, total social financing. That's what officially called, and then M0, M2. It's a few M1, M2 monetary growth. Usually it's positive, but a few times it's been negative in history before. M1 is negative this time. M2 at 7.2% is also a historical, I would say, pretty low number. So overall, these monetary numbers are quite low, and actually some of the local brokerage have released analysis, and some of them got, I would say, disappeared on the Chinese social media. But actually, I think most people know that and also understand that the credit growth is not ideal right now, because many Chinese and households and companies, plus local governments as well, they are in a very risk-averse mode, and many of them are actually, there's some news says like some retirees get up in 5 a.m. try to buy some 3 and 5 year bonds priced at 2.5% yield. So I think that number definitely is low, and confirmed with some of things that I talked before, that the China's local economic condition, resulted from the housing bubble burst, is still very weak. The second thing is, actually some of the questions I got from Twitter, people were kind of saying it's COVID zero. COVID zero is part of the reason, because local government, spend significant amount of money. But I think most of the thing that's going on right now is really is a housing burst and high leverage caused the high leverage in the economy. Now with bubble burst, you have a lot of deleveraging going on. The second thing is China Minister of Finance started selling 20, 30 year and 50-year bond. For many people who are familiar with the US market, actually China in terms of bond market, government bond market, is very, I would say, still very emerging market. Like, it didn't really have a very deep local government bonds trading market, and actually the People's Bank of China is just starting to buy and sell government bonds. They usually don't use the way that Fed uses to manage the rates. So this is a tool that the Chinese developing, and I think this year, if you compare to last year, definitely there was some slight little bit more willingness to you can call it a stimulus, or you can call it central government spending, taking on some debt of the local government. So this year, definitely from some of the state media, you can sense a little bit less strong-willed. Like last year, if you look at the state media, you can see that the government really was not in any mood to spend money from the central bank's balance sheet. This year, a little bit more. But I think the overall, people need to realize that China is never going to do the kinds of stimulus that the US does. And most of these policies is still to avoid the worst. And I think even though the economic data right now is quite weak, I think the sentiment has turned better for probably two reasons. One is, when other markets been going up so much and China has lagged behind, then, capital becomes a little bit more speculative and do these tactical rebound trades. And secondly, during the worst of the sentiment, about 5 or 6 months ago, China's government funds does stepped in. It depends on different measures. Really a couple $100 billion of money has been spent to prop up the market when the sentiment was really negative. So I think those are contributing to this current turning of sentiment. But will this sentiment continue to turn better? I think it's going to be very dependent on the data in the next couple of months, particularly the outside China's headlines is still quite negative, particularly coming from the US. Like this morning, there's a pretty, I would say, extensive tariffs hikes from US, specifically targeting Chinese companies and Chinese made products. Now, I'm not a legal expert and not sure whether these kind of just target one country kinds of tariff, whether China will retaliate through the WTO or not, because usually as members of the WTO, I think there's it depends on how the law is written. But I think regardless, US is increasingly going to use tariffs to protect the industries within US. And the headlines are, probably more related on EV, like electric vehicles. But if you actually look at look at the list, it's not just electric vehicles. There are semiconductors, there are face masks, there are medical gloves. So a lot of these, I think right now, I'm not going to speculate or blame anybody for this. I think for me, my job is really to help people understand and help people to see what's likely coming. And I think more tariffs are going to be coming, and that's been my consistent position, because you can kind of see the writings on the wall, because the US right now is trying to contain China. I know that that's not the official position, but the official position is treating China as a competitor. But I think a lot of these, the older about tech sanctions, like a semiconductor, is just one. And I think tariffs and more protectionist measures that U.S. is also going to take is another, and it's not just limited for EV. And you can see that medical devices is also another area that the U.S. is likely to put in a significant tariff. So again, I think overall with U.S. and China, it is locked in economic competition, and both sides are really, you will say, taking off the gloves somewhat. I think from ordinary people like us, you try to understand and the impact, but there was very little one can do until both sides realize that, it hurts too much to do these kind of things, because it's not costless for the US to do this. Right now, because the US economy is still relatively very good, so these kind of tariffs and sanctions are not going to feel painful. But ultimately, these things will also hurt the US. I think the calculation right now from the US is it hurts China more. So that's why they're doing it. So overall, I think more of these kind of things across the board coming from the US is the baseline. And for China, the baseline is still a very weak consumer and the local government balance sheets, but the government is a little bit, the central government is a little bit more willing to spend than before. So that's the current baseline. Thank you.